This is Intelligent Investing presented by Fidelity Investments. Things have been too good to be true for investors over the past few years, but volatility is back. So what happens now? From March of 2009 to January 2018, the S&P 500 went up 364%, growing at an annualized rate twice the historical average with below average volatility. Fidelity Director of Global Macro, Jurrien Timmer, says it's time to lower your expectations. Volatility has already picked up, most recently from risks of a trade war, and we've seen increased vol in tech from a number of issues, including privacy concerns. The good news, according to Timmer, is that earnings growth looks strong, and over the long run, prices generally follow earnings. But valuations are high, and when valuations are high, financial conditions matter a lot. Timmer uses a simple example to prove this point. If you estimate the value of future cash flows for a company at the current rates and risk premiums, a 1% increase in the discount rate will shave about 4 PE points off a stock's fair market value. So higher rates will put direct pressure on valuations, and so will anti-trade policies, which generally lead to less growth and more inflation. Stocks won't necessarily suffer a major decline thanks to strong earnings growth, but investors should lower their expectations. And it may be time to rebalance your portfolio. PGIM fixed income chief investment strategist Robert Tipp told us last week that the thing he is most worried about investors getting wrong is having an overallocation to equities as stocks have outperformed. And this concern is real. According to analysis from Fidelity, if you had 60% in stocks and 40% in bonds in March of 2009 and didn't rebalance at all until now, you would now have 83% in stocks and 17% in bonds. And increased equity volatility hits your portfolio much harder if you have more equity exposure than you intended.